Revenue, it's probably the most important number on any financial statement, right? It drives profits, it drives valuations, it drives, well, everything. But how we actually get to that number is way more complex than you might think. So today, we're going to pull back the curtain and demystify the rules that govern it all.
So here's the million-dollar question. When does a simple sale actually turn into revenue on the books? Is it when the money lands in your bank account? The moment you send out an invoice? Or maybe it's only when the customer physically has the product? It seems simple, but trust me, the answer has huge implications.
Okay, to really get why this is so tricky, let's walk through a real-world scenario. Let's imagine a real estate developer. They've just pre-sold an apartment that won't actually be built for a few more years. Seems pretty straightforward, but the timeline is where things get interesting.
So, picture this. In 2026, they get that first chunk of cash, the booking amount. Then, for the next 3 years, from 2026 to 2029, the building is under construction. And finally, in 2029, it's done. The keys are handed over, and the buyer officially takes possession. 3 very distinct points in time for a single sale.
And that, right there, is the heart of the problem. So what do? Do they book all that revenue way back in 2026 when they got the first payment? Or maybe they should spread it out evenly over those 3 years of construction. Or do they have to wait all the way until 2029 when the flat is 100% finished and delivered? This kind of confusion is exactly why Ind AS 115 was created.
To really get why this new standard is such a big deal, you have to understand just how messy things were before. Before Ind AS 115, the system for recognizing revenue was, well, it was all over the place. We desperately needed one single, unified model.
Think of it like this. Back in the day, every industry had its own rulebook. If you were selling goods, it was all about transferring risks and rewards. If you were in construction, you used a method called percentage of completion. And if you were a service company, well, you had a whole bunch of different methods to choose from. It was chaos.
And this was a huge mess. It led to some really big problems. You couldn't compare a software company to a manufacturing company. Reporting was just wildly inconsistent from one business to the next. And honestly, it created a lot of room for companies to play games with their numbers. As an investor, how could you possibly trust the numbers if everyone was using a different rulebook? Something had to change. And then, everything changed. And it all came down to one single, really powerful idea, the control principle. This one concept is so elegant because it just cuts through all that old confusion.
So here's the game changer, the core idea of Ind AS 115. It says that revenue is recognized when and only when control of the goods or services is transferred to the customer. It's not about risks anymore. It's not about rewards. It's not about when the cash comes in. It's all about one thing, control. If you remember one thing from all of this, remember this: transfer of control. That's it. That's the key that unlocks everything in modern revenue recognition. Okay, so having a core principle is great, right? But how do you actually use it in the real world? Well, that's where this beautiful 5-step blueprint comes in. It gives you a structured, logical way to handle any revenue situation, no matter how complicated it gets. So here they are, the 5 steps. First, you identify the contract. Second, you identify the performance obligations, or the promises you made. Third, you determine the transaction price. Fourth, you allocate that price. And finally, the big one, step 5, you recognize the revenue. Now let's break each one of these down.
All right, step 1, identify the contract. Now this sounds super simple, right? A contract is a contract. But as you're about to see, in the world of accounting, there's a little twist. It's not just about having a signed piece of paper. So let's say a company sells some heavy machinery to a customer. But here's the catch. That customer is in really bad financial shape. Even if the machine gets delivered, the seller thinks there's almost no chance they're actually going to get paid. Well, under these rules, there is no contract for accounting purposes. And no contract means no revenue. Period. And this is a massive takeaway. Just because you have a legal document, it doesn't mean you have a contract in the eyes of an accountant. The probability that you're actually going to collect the cash is absolutely crucial.
Okay, let's keep building. Moving on to step 2. So, we've decided we have a valid contract. The next question is, what exactly did we promise to deliver? These distinct promises are what we call performance obligations.
Think about the last time you got a new phone plan.
You likely got a package deal, right? A new handset, a SIM connection, and maybe a 1-year service plan all rolled into one. Well, from an accounting perspective, that's not one big sale. It's actually 3 separate, distinct promises, 3 performance obligations.
All right, now for step 3, determine the transaction price. This is all about figuring out the total amount of money the company truly expects to get for doing what it promised. But sometimes, that price isn't set in stone.
Let's say a contractor gets a job. The deal is 10 lakh rupees, guaranteed. But, hey, if they finish early, they get a 2 lakh bonus. That potential bonus is what accountants call variable consideration. And the rules say you can't just ignore it, you have to carefully estimate it and include it in the transaction price right from the very beginning.
Okay, step 4. This is where we connect the dots from the last 2 steps. We've got our promises, our performance obligations, and we've got our total price. Now we have to split that total price among each of those individual promises.
You've seen this a million times, right? You buy a laptop, and it comes bundled with software and a year of tech support, all for one single price. Even though you just paid once, the company has to take that total price and allocate it. They have to assign a value to the laptop, the software, and the support service, usually based on what each of those items would sell for on its own.
And here we are, the moment of truth. Step 5, the big one. Recognize revenue. This is the finish line. This is where we finally get to put the number on the income statement. But when you do it, all depends on how control is transferred to the customer. And really, this can happen in one of 2 ways. You can recognize revenue over time, like our real estate developer. They'd recognize a piece of the revenue as the construction work gets done. Or you can recognize it at a point in time, like when you buy something at a retail store. The moment they hand you the product, control is transferred, and boom, the revenue is recognized right then and there.
So there you have it. That's the whole framework from start to finish. I know it seems like a lot to take in, but it all comes down to that logical 5-step journey. So let's just quickly run through it one last time. So let's just hammer it home one last time. The 5-step blueprint is 1. Identify a real contract. 2. Figure out your separate obligations. 3. Determine the total price. 4. Allocate that price to each obligation. And 5. Recognize the revenue